We can all agree that the past 4 years have materially changed the world that we live in and how people treat their personal finances in the same way that any world-rattling event has throughout history. The pandemic's opened our eyes to circumstances and pitfalls that we hadn't ever considered and has left residual impacts on many facets of our financial lives. I mean, the expression out of the frying pan and into the fire has now taken a whole new meaning for most households, where now that the dust has started to finally settle, it's everyday people that are feeling the repercussions that billions in fiat currency printed and artificially low interest rates have left behind. Essentially, the money-making party's been over for a while now. So in this video, let's actually speak about these repercussions and, if we're lucky, maybe a couple of positives I've actually managed to squeeze out of this situation. Let's get into it. Okay, let's get this straight. I personally use credit and credit cards all the time. Actually, I never buy anything outside of on a credit card. Seriously, you're giving up points, purchase protection, and a whole bunch of other benefits. But it's important to still consider that there's a major difference between proper and poor credit card use, which has been heavily overlooked over the past couple of years, resulting from the pandemic. In fact, for the first time ever, total physical credit cards in the United States have exceeded 500 million, led mainly by Gen Z, ages 18 to 25, with credit card balances jumping 13% in the second quarter of 2022, which is the largest increase in more than 20 years. Bottom line here, people are simply struggling to keep up with the rising cost of living, which really isn't surprising when you consider the values that we'll be looking over shortly. But back to credit for a second here, cards and personal loan usages are only expected to further increase over the next couple of quarters and years, which is directly tied to the lasting financial repercussions left behind by the pandemic. And realistically, for the millions of people who are now carrying forward these larger credit balances, this of course weighs heavily on your credit score and therefore ability to qualify for loans such as, say, a mortgage loan and ability to purchase a house, but that's a whole other battle to deal with. Speaking of the rising cost of living, let's now speak about the silent tax, also known as inflation. If you aren't familiar with inflation, it's essentially the rising cost of goods and services over time, where each dollar that you have in your pocket can purchase less of that same item. It's the reason why a cup of coffee in 1970 will cost you 25 cents, whereas a cup of coffee in today's value might run you $2.25. Of course, other factors also come into play here, like supply and demand, but what I'm trying to get at here is that the pandemic had a massive hand in the inflationary environment of recent history. In fact, as of June 2022, inflation hit a 40-year high of 9.1% in the United States, which has materially impacted the average household savings rate quite negatively. We'll get into that a bit more shortly, but to give you an idea of how inflation truly is the silent tax, the average savings rate in the United States has been around 6% since the early 2000s, meaning the true savings rate relative to its purchasing power would currently be nil or even negative, which of course is a problem. And if you've been following, this means that once inflation is tamed back down to what's considered to be a reasonable level, well, millions of households will be left catching back up on first paying back that newly acquired debt before being able to save anything. To summarize, income, interest rates, and inflation levels highly impact household personal finances, which all lead me to my next point. Amazingly, during the pandemic, when everything was closed and people had nowhere to actually spend their money, the personal savings rate surged to over 33%, but only very temporarily. And yeah, like I said earlier, the financial repercussions for average households are still being felt to this day, with the current savings rate now having dropped below 3%, which isn't ideal at all. In fact, as of most recent data, nearly 40% of individuals claim to not be able to put any money aside whatsoever for their savings, while an additional 19% claim to have reduced their savings rate. What's more is that prior to the pandemic, 71% of Americans claim to have had a sufficient emergency fund in place, right? The account that everyone should have for periods of dried up income, whereas now 42% say that they need to entirely replenish this emergency fund, with 44% saying that they need to drastically increase the size of it moving forward. So while internet personalities like Grant Cardone, for example, will tell you that you should never keep any cash in savings whatsoever, the reality is that this type of financial blanket statement simply doesn't apply to everyday working people who are highly impacted by the fluctuations of the economy. Bottom line, the need for zero risk money is being felt more than ever, and everyone watching this video right now needs to build up a sizable savings account. Now, what happens when interest rates are low and billions upon billions of dollars are pumped into the economy? Well, just ask the markets of 2020 and 2021. At this point, we all know that asset prices have surged quicker than pretty much ever before, but while reality is now setting in, with the crypto and equity markets shaving off the past couple years of gains and the real estate market colder than it's been since 2008, things have only gotten worse for everyone's largest monthly expense, housing. And I'm talking about property prices just as much as I am average rent values across most North American cities that have greatly jumped since 2019. The thing is, we can't forget what we just spoke about, where property values may very well be dropping back down to pre-pandemic levels, but what's arguably even more important for the average individual are monthly running costs that have greatly increased as a result of increasing mortgages, which are higher than ever due to inflation and, well, increasing interest rates. The $500,000 house in 2020 at a 2% interest rate has the same monthly mortgage payment as the $350,000 house at a 5% interest rate. This is bleak news for buyers right now, but the catch-22 here is that once interest rates do inevitably start dropping back down once again, which I personally have mentioned on the channel that I think will be somewhere in the next 12 months, well, property values have nowhere to go but up. So the pandemic's led to the overall cost of housing increasing, with affordability dropping down even further, which is only going to contribute to a larger discrepancy in wealth over the next couple of years and decades, as most North American wealth is tied up in real estate. Oh, and by the way, if you want to learn more about how you can start investing in real estate yourself and growing your wealth through this asset class like I've been doing over the past 5 years now, check out my Udemy course. It has great student feedback so far and a ton of jam-packed value. Okay, but arguably not everything has been financially negative resulting from the pandemic. Yes, it's been tough for many individuals, but it's also flipped the script for millions of individuals who are now more in tune with what's financially possible. Prior to the pandemic, how many of you were realistically interested in personal finance and investing, right? For anyone under even 25, 30, probably not too many. To back this claim up, well, I've recently been making content about these very topics since 2018, and it's only when the pandemic hit the world by storm that my content started getting flooded by new retail investors and people interested in the world of personal finance, which is definitely a good thing. For the first time in history, tens of millions of individuals started taking their personal finances and investing into their own hands with the popularization of ETFs and other low-cost investment vehicles. Additionally, it used to be so difficult to open up an investment account even like 5 years ago. So while the gamification of investing that many discount brokerages emphasized has been scrutinized by many, I think ease of access to investing is a net positive for the average investor. So if there's one positive that's risen from the ashes over the past 4 years, it's that access to information on the topics of personal finance and investing are more prevalent and sought after than ever, with millions now realizing the importance of proper saving and investing habits. No one knows for certain, but if we look at patterns and signs of past behavior by the Federal Reserve and other central banks, higher interest rates tend to follow surging inflation levels with the goal of stabilizing the two. We're already seeing inflation levels dropping across the board and central banks treading water, looking to avoid plummeting the markets even further than they have already. This could very well mean that interest rates will probably start to drop as well over the next 12 months or so as inflation levels trend down further, hopefully, and consumer sentiment isn't nearly as bearish. In which case, asset prices will theoretically start to stabilize and increase as of late 2023 and into 2024, but who knows? So in a world where it's now easier than ever to get financially distracted with the next new stock or NFT project, the most important steps you can take are to start paying down any higher interest debts and then building up an emergency fund of savings with a financial plan in mind, while also increasing your income through a side hustle or extra side job. Oh, and by the way, if you're new here, my name's Griffin, and you should definitely check out all of the other content I have on my channel about investing and personal finance. I also have a free stock market investing course that you can check out on Skillshare, and as I mentioned earlier, that real estate investing course over on Udemy. Definitely check those out if you're interested in growing your wealth through those two investment vehicles. Thanks a lot for watching, and I'll see you in the next one.